Thanks for watching this Magellan quarterly video update. Today I'm speaking with Gerald Stack, the Head of Infrastructure Sector and Portfolio Manager. Gerald, there have been French elections and British elections over the last quarter with the Conservatives losing the majority vote. What's your read on the sovereign risk associated with these countries?
Thanks, Frank. Well, I guess we're concerned about sovereign risk generally to the extent that it means that governments are potentially going to interfere in the rights or in the rights of infrastructure and utilities companies in which we invest, or in general interfere with their underlying business operations. The nature of infrastructure is that you generally spend a lot of capital expenditure, a lot of capital investment right up front, and you're relying upon a long series of reliable cash flows well into the future. So to the extent that changes of government interfere, lead to interference in those long series of reliable cash flows, then clearly that's a concern. On the basis of the platform that's been espoused by both the elected French Macron government and Theresa May and her party, we see no real changes to underlying sovereign risk. Sovereign risk always got to be something that we think about. We can't get away from it, but we see no real changes in the underlying sovereign risk environment at the moment.
So Gerald, are there regions or jurisdictions that do keep you up at night, notwithstanding the fact that you may not be invested? Maybe talk to us a little bit about that.
As I've talked about previously, the nature of infrastructure investment is you outlay a whole heap of capital at the start, and you're relying upon a long series of cash flows into the future. So sovereign risk is critical. So provided we're confident in the sovereign risk standards and I guess the regulatory standards buy into that, then we're generally pretty comfortable about investing into those environments. The nature of what we invest in is essential assets that provide essential services. And if a service is essential, then ultimately there will be demand and there should be revenue and therefore earnings. So those regions where we want to avoid are those places where we can't be comfortable about sovereign risk. So for example, China. China has incredibly attractive themes as it pertains to infrastructure investment. Car ownership's grown very strongly over the last 20 years. The number of people using aviation, flying through airports is growing again very, very strongly over time. But the Chinese government over time has interfered with the rights of private companies on a number of occasions in the infrastructure investment as well in other sectors. And that's often for very good public policy reasons. An effort to fight air pollution has led to restrictions on the number of flights that have happened through airports from time to time. Efforts to fight food price inflation have led to restrictions restrictions on the tolls paid by trucks carrying food and the like from time to time. Very good public policy, but if we own the asset, then we want some compensation for that. The nature of infrastructure is it's get rich slow, not get rich quick. It's building wealth slowly with confidence, reliable returns. So those jurisdictions where we can't be confident about the way that we'll be treated as owners of the assets over time are going to be jurisdictions that we avoid. So we avoid China. We exclude China from our potential investable universe. We exclude Russia from our investable universe and other similar jurisdictions. Where we have seen a track record of governments seeking to interfere with the rights of private companies, that's gone to a court of law and the court of law has upheld the rights of the private company, then for us that's eminently investable. So for example, on that basis, Brazil, albeit non-OECD, an emerging market, eminently investable on that basis. So that's essentially the test that we use, and on that basis there are various jurisdictions we will seek to avoid, but there are also plenty of jurisdictions that we're happy to invest in.
So Trump and his infrastructure plans, what's your read on those plans?
Yeah, so I guess the first thing is that at this point in time, the Trump infrastructure plan is certainly not determined. We don't have a definitive set of ideas in terms of what the plan might or might not be. Broadly speaking, we would see it as directionally positive to the extent that he does come out with a plan, but unlikely to move the needle too much. And there's some reasons behind that. The first thing is that infrastructure development tends to be a state issue rather than a federal issue. Clearly the Trump government can put in place some tax concessions of some sort and that may encourage what's going on, but ultimately we see it as a state rather than a federal issue. Secondly, the nature of infrastructure asset development is that it takes long periods of time. It requires a lot of planning, both red tape, if you like, but also environmental planning, green tape. So we're not sure, or it's not readily apparent to us what the Trump infrastructure plan will do to change those environments. As I said, we see it as directionally positive. We think pushing a plan that's proactive in terms of infrastructure is directionally positive for infrastructure development, but we don't see any significant change, certainly in the short to medium term.
And when those plans start coming into play, do you see opportunities for private investors to participate?
We expect that there will be some opportunities in the private environment, but ultimately we suspect most of those opportunities in the private environment will go to unlisted infrastructure investors rather than listed, and for the simple reason that at this point in the cycle, as it were, unlisted investors appear willing to pay more for infrastructure investment opportunities than listed opportunities. And we see that right here in our own state of New South Wales, where the electricity utilities are being privatised by the New South Wales state government to varying degrees. And the bulk of the participants in that process have been unlisted investors rather than listed investors in one way or another. So we would see in the US, to the extent that there is that the Trump administration infrastructure plan does lead to opportunities, we would expect the bulk of those to go to unlisted investors.
Gerald, we hear from some investors that valuations generally are stretched. Is this your observation in the infrastructure sector? In a nutshell, no. We would say that infrastructure today is fairly valued in totality, but that doesn't mean that there aren't some pockets that look expensive in addition to pockets that look like attractive opportunities. When we think about valuation, we think about it as two buckets. Or when we think about infrastructure, I guess we think about two buckets: regulated utilities on the one hand and infrastructure on the other. Now, regulated utilities generally have a compact with their communities whereby they're allowed, permitted by a regulator to set their prices such that they can achieve a fair return on their equity base over time. That fair return shouldn't matter what happens to the underlying economic activity. That fair return should be very stable and reliable over time. Regulated utilities represent around about 60% of the potential investment opportunities in our universe. So the bulk of our universe should have a fair return. It's certainly not get rich quick, but they should be able to build wealth for investors with a high degree of reliability over time. Now, that theme of reliability of earnings has been one that's been very popular in investment markets over the last 5 years, and we certainly would see regulated utilities as being at the more expensive end of what we do today. As I said, it's 60% of our potential universe. It's approximately 30% of our fund today. So we're essentially underweight that portion of our potential universe. On the other hand, infrastructure, the remaining bucket that we can invest in, 40% of our universe, infrastructure tends to be regulated through price rather than earnings. So think a toll on a toll road or a charge paid by a passenger going through an airport. Therefore, if we can find infrastructure assets where volume patronage, traffic on a road, passengers down an airport, can grow at reliable, robust rates over long periods of time, then we can find assets that can earn a high and growing return on their capital. In addition to which their prices, the toll on a toll road, the price through an airport, is typically linked to inflation, so you have inflation protection as well. So in that infrastructure space, ideally, if we can find those things with very reliable growing patronage over time, we should be able to find attractive opportunities. And today, the infrastructure sector, the infrastructure component of our universe represents around about 60% of our fund. So 30% in utilities, 60% in infrastructure. We're heavily overweight infrastructure, and that's where we see the bulk of the opportunities today. The remaining 10% of our portfolio is in cash, and as we've discussed in previous videos, we're holding a high level of cash just at the moment. We're holding a high level of cash because we do expect interest rates to normalise somewhat. And as that happens, we think there are certain parts of our universe that are likely to find tough conditions in the market, and we look to participate in that. Thanks, Gerald.
Thanks, Ferry.
And thanks for watching. Feel free to forward this video link on to colleagues and clients that you think might be interested, or obviously find more information on our website. Thanks.